Hi, Jeff.
Hey, Meesha.
Welcome to another episode of the North Atlanta Real Estate Podcast with your host, Meesha
And Jeff Aughey.
And in continuation with the Federal Reserve meeting that concluded yesterday, headed by Jerome Powell, what was the Federal Reserve's decision regarding interest rates, Jeff?
Yeah, so as expected, what they ended up doing was lowering by 25 basis points or a quarter point down into the 4% to 4.25% range. And so that's the discount rate. And so that was largely expected. So mortgage rates didn't really move much. In fact, as we can see even today, if we look at the market right now, the 10-year Treasury, which is a pretty good indication of how mortgage rates are going to move typically, is actually up slightly, up 4 basis points. And so even though they announced this cut, it didn't really affect things and didn't bring things down, which was also expected, right? We've talked about that ourselves, right? So.
Yeah, but the stock market got a little bit of a boost.
Yeah, it did. And I think maybe some of this is, and people, of course, they'd like to focus on, they have happy ears sometimes, and they like to focus on certain parts. He did say in subsequent remarks released in the decision is that they also may reduce a quarter point in their end of October meeting between the 28th and 29th, and then their December meeting, which is, I think, the 9th and 10th of December. And so if they reduce a quarter point in each of those, that is something that's not guaranteed yet, and that probably could affect our rates and could affect things. And so I think maybe some of today is they're happy that they're even considering that's, something that's on the table. Jerome Powell did say that is a wait and see. That's going to be data dependent. Is the labor market still weakening? Is inflation under control to allow them that latitude to make those cuts?
So is that the FOMC's outlook for future rate cuts in the short and medium term?
Well, that's certainly in the short term. And then I think they've also talked about that they would expect further cuts in 2026. But when you start to go out that far, it's impossible to predict what the economy is going to be doing. If our economy strengthens again and all of a sudden there aren't any jobs getting lost and they're actually adding again, or inflation ticks up, then these rate cuts will be off the table. So, it's going to be a kind of a wait and see the data as it comes in. And, so.
So, I know some of our listeners might be interested in figuring out, does this compare to the market expectations, what the Fed did?
Yeah, it did. I mean, I think this was the baseline expectation. Nobody was really expecting a half a point. So this was expected, and that's why it didn't really move the market much. It was already priced into the market. This is what expected. So, yeah. Mm-hmm.
No, I mean, we're really hoping that future rate cuts, if possible, will clear up and break the logjam in the housing market and bring more buyers, sellers, and investors out.
Yeah, I mean, we still have, as we often discuss, the challenge of the low rates that were basically 3%, some a little lower, right? But in that 3% range, the people still don't want to give that rate up, because even if we're going to be getting 6.25% now, that's still 3% extra that you're paying your mortgage rate. It does make a difference. If you're talking about a $500,000 mortgage, 3% is, that's almost $1,000. So on your payment for your mortgage payment. So that is significant. And so we have that challenge. And so there's some talk, and I think you even were telling, what was the expectation we needed to get the rates down into the...
Yes. Some economists have predicted that if the interest rate drops down to 5%, there'll be 30% more houses on the market. So we'll see a lot more inventory, and buyers will have a lot more to choose from. But also because a lot of homeowners will be able to put the house on the market, and we've seen some homeowners toy with the idea of becoming landlords because they have this low interest rate that they either bought in or refinanced at, and they don't want to give that up. So they prefer to have a tenant. But for some homeowners, they need that equity to be freed up when they buy a house.
To be able to buy, to have the down payment for the next house. Yeah, so that's going to be very interesting to see, and I think that's going to be the story as we are heading into next year, is what is that rate level, and what is that going to mean for, are we going to have more inventory and such things? Are prices going to go up if enough buyers flood into the market, but inventory doesn't go up a lot? We might have this kind of home bids again,
And what sometimes we look at paradoxes in the interest rate and the home sales. And when the house prices were high back in 2023, 24, and the interest rate was close to 7.5%, 8%, we had a sudden surge in home sales. And now with the real estate market kind of slowing down, interest rates slowing down, we are hoping that same surge comes in and does not work inversely to the economy.
Yeah, and so what would be the normal seasonal factors, Meesha? Here we are, I guess, in middle of September. What can people expect generally? What are the seasonal factors as we head to the end of the year?
Yes, now with the schools being reopened and Christmas looming, a lot of kids are trying for their college entrance exams, and people are like, well, we can't move. The job market not being as secure as it was. We are seeing a lot of, seasonality is very important in real estate. So we're seeing a little bit of a slowdown, but we're also seeing a lot more buyers kind of come in now that school's open to see what else is out there. So there's a lot of people who've slowed down their home search, but also that's kind of made way for some new home buyers who've come into the market.
So, I mean, I've often heard, right, that, and certainly experienced over the years, that it will stay fairly active maybe up until about Thanksgiving or so. And then does it get quiet between then and the New Year?
And New Year's. And historically, January's always spiked up for real estate. And it's very interesting because I think Christmas brings in this, that fever of, I want to be in my new house by Christmas. So a lot of people who are not able to close during Christmas because closing attorneys' offices are closed, lenders don't work as much, end up buying a house, you end up closing on a house in January or after the Christmas season passes. They're like, well, we wanted to be in our own house. So January typically spikes up before slowing down in February.
And so maybe because certainly one thing I've noticed, and it bears out by the data if we look at it, it can be a great time for a home buyer to consider a purchase right around Thanksgiving up to that Christmas time period, because some buyers are out of the market. They're thinking about the holidays and they've got other focus going on. And so it's a good time that maybe you can sneak in there and find a good deal on a particular house, especially if it's vacant and the seller's under pressure.
Absolutely. And we'll keep an eye on the market for our listeners. And if you have any questions about the current interest rate, future trends, feel free to reach out to either myself or Jeff, and we'll be happy to answer any of your questions.
Yeah, perfect.
All right. It was a great episode, and look forward to seeing you at the next episode. Bye, Jeff.
Bye for now.